Have you ever dreamt of owning your own home? That feeling of walking through the door and knowing it's truly yours is something many of us aspire to. But as exciting as it sounds, the journey to home ownership can come with a hefty price tag. In today's video, we're going to unravel the mystery of how much money you really need to buy a house. From the down payment to the hidden costs that catch many buyers off guard, we'll break down the numbers and give you the insights you need to make your dream home a reality. In this video, we're going to peel back the layers and reveal the secrets that could save you thousands of dollars and countless headaches. Whether you're considering a cozy family home in the heart of the Midwest or a luxurious coastal retreat on the West Coast, understanding the true cost of homeownership is the first step towards turning your dream into a reality. Get ready to take notes, because by the end of this video, you'll be armed with the knowledge and confidence you need to navigate the complex world of real estate. So without further ado, let's get started. First, let's talk briefly about renting. And let's put it this way. If you're renting right now, your rent payment will probably be the highest cost you'll pay when talking about your living expenses. But if you're thinking about buying, there could be extra costs you need to consider before signing the mortgage. So it's essential to know the big difference between buying and renting. Renting means a fixed payment without surprises like unexpected city charges, HOA fees, maintenance costs, lawn care, and others, which will occur when you own a home. A very important additional cost is property taxes. It's interesting to note that a state like New Jersey often has the highest property tax rates, while other states like Hawaii and Alabama boast lower average property tax percentages. Home insurance costs can also be a substantial expense that needs to be considered. And let's not forget about unforeseen expenses like foundation or roof repairs, which can add unexpected financial burdens to home ownership. As you can see, buying a house can be a major expense, and especially when prices have gone up from the last year of 2023 and continuing into 2024. According to Business Times, housing prices, already high, surged by nearly 40% over the past 3 years. Adding to the challenge, available homes have become scarcer, with listings down nearly 20% over the same period. In places like Spokane, Washington, various areas in Florida, and California, known for having some of the most expensive homes in the country, there's a significant shortage of homes that their people can actually afford. To complicate matters further, interest rates have recently reached the highest point in 20 years. This increase in interest rates impacts the ability to purchase homes, and surprisingly, it hasn't led to a decrease in housing prices. Instead, it contributes to the intricacies of the present real estate situation. Now let's compare the mortgage rates with those from a few years ago, say around 2020. Back then, with a 3% interest rate, the landscape looked quite different. Consider a $500,000 home purchase with a 20% down payment. At that time, your mortgage payment would have been around $1,700 per month. Now with the current mortgage rates in 2024, let's calculate the monthly payment for a $500,000 home. With a 20% down payment at a 5.87% interest rate over a 30-year period, the monthly payment for this home would be approximately $2,400. This means that, compared to a few years ago, the monthly payment for a $500,000 home has increased by around $700 monthly, and over a year, this difference accumulates to $8,400 annually, which comes to a whopping $250,000 more paid at the end of your mortgage compared to an interest rate from 2020. This comparison underscores the substantial impact of changes in interest rates and home prices, helping you understand how these factors influence the financial aspects of home buying. If your dream is to own a home in one of the priciest locations, such as the San Jose Sunnyvale and Santa Clara area in California, brace yourself. You'd be looking at a substantial investment of $1.8 million for the average property in these areas. Quite the eye-opener, isn't it? On the other hand, in one of the most affordable places in the US, like Decatur, Illinois, you could buy a house for just a small down payment that you'd use in San Jose. Homes there have a median price of $133,400. However, according to Forbes, these affordable places usually see lower school ratings, experience violence and property crimes that are significantly higher than the national average. Here's the average sale price for homes in different parts of the country according to the latest update by the National Association of Realtors. West, $610,500. Northeast, $467,500. South, $366,200. And Midwest, $304,600. Now that you have an idea of the impact on interest rates when buying a house, we can discuss what upfront costs you need to cover when signing your mortgage. The good news is that you typically don't need a hefty 20% down payment. Around 5% should usually suffice for most lenders and buying programs. However, there's a catch. On top of your down payment, you may need an extra 5% for closing costs, covering mortgage fees, due diligence, and other fees. It's estimated that for every $100,000 of the home's cost, these closing costs can range from $2,000 to $5,000. So on a $500,000 home, you might face closing costs between $10,000 and $25,000. Now, when it comes to owning a home, there are ongoing financial responsibilities. The mortgage is like a long-term loan lasting 15 to 30 years. And if you have a fixed interest rate, your payment remains constant until the loan is fully paid off. Then, you'll need to handle property taxes and annual fees, calculated as a percentage of your home's purchase price. These percentages may go up each year, especially in locations such as Texas. In Texas, property values have been on the rise, impacting the annual fees homeowners need to pay. This means you might experience a notable increase in your expenses over time. Understanding these specifics is crucial for effective financial planning. Home insurance, as we mentioned, is an essential expense of being a homeowner. Your lender requires you to have home insurance to protect against unforeseen events like a tree falling on your house or a burst pipe damaging your property. This requirement is in place to ensure that your investment is safeguarded. It's crucial to note that lenders may have specific demands regarding insurance, and it's advisable to research until when these demands persist. Additionally, paying off a certain amount of the loan may influence the lender's requirements for insurance coverage. Homeownership also means taking charge of repairs, fixing your plumbing issues, electrical problems, or dealing with roofing concerns. People typically budget around 1% of their home's value each year for repairs and other expenses. Overall, owning a house tends to be more expensive than renting, influencing what you can genuinely manage. However, keep in mind that even though it might be more expensive, you're also building equity, which sets it apart from merely paying rent. Nevertheless, it's crucial to do your own personalized calculations as the equity factor varies for each situation. Now that we've explored the costs of buying a home, let's shift our focus to understanding the income you need to make your dream of homeownership a reality in the United States. To guide us through this, let's talk about a simple rule when buying a home, the 3-30-10 rule. A straightforward approach to managing your finances on the path to homeownership. Starting with the 3, it suggests don't spend more than 3 times your annual income on a house. For instance, if your household earns $200,000 annually, this rule recommends a price cap of $600,000 for your home purchase. The aim is to ensure a reasonable house payment, alleviating financial strain. Although this may present challenges in high-cost cities, it encourages exploring alternatives in locations that better align with your financial goals. Now let's shift our focus to the 30 in the rule, recommending that you save up 30% of the home's purchase price before buying. For instance, if you're eyeing a $500,000 house, strive to put down 20%, which is $100,000 at closing. The remaining 10%, or $50,000 in this example, serves as an emergency fund, ensuring financial security to cover mortgage payments for over a year and any one-time fees that come when buying a home. Lastly, the 10 underscores that you should allocate no more than 10% of your gross income to your mortgage payment. Achieving this can be challenging, especially in a high-interest rate environment. It may require a 30-year mortgage, a higher income, and choosing to live in a more affordable area or a modest home. Some opt for unconventional approaches, such as having a roommate, creating an Airbnb space, or owning a duplex and renting out one side. In fact, the average mortgage payment rises to 28 to 30% of your gross income. It's worth noting that larger down payments can also contribute to lowering your monthly payment. Lenders like to see a consistent income over the past 2 years. They also check that your total monthly debts, including those on your credit report and your proposed mortgage payment, don't surpass 50% of your pre-tax income. To put it in perspective, let's consider some salary examples. Suppose you earn $60,000 annually. Following the 50% rule, your total monthly debts, including the mortgage, should ideally be kept under $2,500. Now, with the rise in home prices and mortgage rates, purchasing a home has become more challenging. According to the National Association of Realtors, or NAR, individuals looking to buy a home in mid-2023 need nearly double the income compared to home buyers in 2020. For instance, if in 2020 you needed an income of $50,000 in 2023, you would likely need around $100,000 to meet the increased affordability demands. So it's wise to consider whether it makes more financial sense to rent or buy. Surprisingly, in most places, renting is cheaper. If you decide to buy, make sure you get a good deal, maybe with a low interest rate or in an area expected to grow. Being patient can save you money in the long run. Now, as you plan for your new home, considering the financial aspects beyond the purchase is crucial. You might be wondering, I have the income, but how do I save my money? Here's a strategic approach. Instead of relying solely on the funds you've saved, set aside additional reserves for unforeseen and irregular expenses. Sometimes, your lender might recommend having a backup fund, typically 2 to 6 months worth of your regular expenses. This becomes especially important if you're buying a second home, your credit score isn't great, or you have a significant amount of debt compared to your income. The general rule is to have enough reserves to cover at least 1 month's housing costs, encompassing property taxes, association, insurance premiums, and of course, your mortgage payment. To play it safe, it's advisable to maintain reserves for 2 to 6 months, covering all your expenses, not just those related to your house. Now, even if you've covered the initial costs of buying a house, like the down payment and closing fees, there are other expenses you need to save up for, such as moving expenses, home repairs, cosmetic improvements, furniture, home maintenance, and emergency savings. When it comes to a $500,000 home, the down payment typically ranges from 0% to 20% of the purchase price, which equals up to $100,000. Closing costs, usually 0% to 5% of the borrowed amount, can amount up to $25,000. Additionally, it's advisable to maintain emergency savings or cash reserves that can cover up to 6 months' worth of housing expenses at $3,000 per month, totaling $18,000. To summarize, the overall amount required for these aspects fall around $140,000. Keep in mind that these estimates vary due to diverse financing options and individual financial situations. To get a more personalized estimate, explore your financing options through number 1, checking low down payment mortgages and first-time home buyer assistance programs to see what you might qualify for. Number 2, getting pre-approved for a home loan with a few lenders. And number 3, having a conversation with a local mortgage broker for more tailored advice. Owning a home symbolizes the American dream, offering stability and accomplishment. However, it's crucial to research and be discerning before committing to home ownership. Surprisingly, in many places, renting is more cost-effective. Beyond upfront costs like down payments, owning a home comes with ongoing responsibilities. Stay informed about the evolving housing market and consider if renting might be a wiser short-term financial choice. In wrapping up, let's quickly revisit the rule we talked about earlier, the 3-30-10 rule. This rule advises, number 1, keep the house price under 3 times your annual income. Number 2, save up 30% of the home's price before buying for a secure financial footing. And lastly, number 3, allocate no more than 10% of your gross income to your mortgage payment. Understanding and adhering to these rules is crucial as you begin your journey to homeownership. So whether you're eyeing that Midwest home or a coastal property, arm yourself with the right knowledge and financial planning. Looking for the best city to move and buy a home? According to Forbes, North Carolina stands out as a state that has one of the top 10 cities to move to. As of January 2024, the median listing home price in Asheville, NC, remains steady at $552.4 thousand year over year. Based on the information captured in this video, understand what income you need for a $500,000 home. And who knows, you'll be moving to North Carolina this year. If you found this useful, give us a thumbs up, subscribe, and hit the bell for more insightful content on lifestyle and finance. Thanks for joining us. Happy house hunting!